All right, let's dive into the latest financial report from Lippo Mall's Indonesia Retail Trust, or LMIRT. And this one is a real puzzle. The numbers seem to be telling two completely different stories at the same time. So today, our mission is to piece it all together and figure out what is really going on with this company. Okay, so let's get right to the heart of it because this is the central mystery of LMRIT's latest results. On one hand, you've got gross revenue up a very healthy 7.5%. That's the kind of number that usually makes investors happy, right? But then you look at the other side, and the distribution per unit, the actual cash paid out to the people who own the company, is zero, a big fat zero. So how on earth does a company bring in more money but have absolutely nothing to share with its owners? What's the real story here? Well, that's exactly the puzzle we're going to solve. And to get to the bottom of this, we're going to break it down step by step. First, we'll look at this mixed financial picture that the big headline numbers are painting. Then, we're going to take a much closer look at that revenue growth to see where it's actually coming from. From there, we have to talk about the massive debt mountain that LMIRT is trying to climb. And that, you'll see, leads us right into their cash conservation strategy, which is the real reason for that zero payout. And finally, we'll look ahead and try to figure out what's next for the trust.
All right, section 1, the big picture. These are those headline-grabbing numbers, and they really set up the whole puzzle perfectly.
So first, the good news. Gross revenue for the third quarter came in at $51.5 million. That is a 7.5% jump from the same time last year. Now, on the surface, this looks fantastic. You think, okay, more shoppers, maybe higher rents, business is good, right? It's a really solid top-line growth number, and it suggests the malls themselves are doing well. But as we already know, that is definitely not the whole story. And here is the other side of that coin, $0 paid out to unit holders. The contrast couldn't be more stark. It's kind of like getting a big pay raise at your job, but then finding out that every single extra dollar you earned is being automatically funneled to pay down this massive high-interest credit card you've been battling. So you're technically earning more money, but your bank account is actually emptier. That's the situation investors in LMIRT are in right now, and it's all because of what's happening behind the curtain. So let's move on and dig a little deeper. We need to unpack that 7.5% revenue growth. Is it really as strong as it looks on paper? Or is there something else going on? Let's take a look. Okay, so this chart breaks down where the money's coming from. You've got rental revenue. That's the core of the business. It's up a little over 3%, which is pretty solid. It tells you occupancy is probably getting better. Service charges are also up a bit. But wait a minute. Look at that third bar. Car park revenue. It's S3.3 million this quarter. Last year, it was just S1.5 million. That's more than double. That's a huge leap, and it's responsible for a massive chunk of that overall revenue increase. So what happened? Did twice as many people suddenly start driving to their malls? Well, not quite. And this little quote from their report tells the real story. The secret here isn't a sudden parking boom, it's just a change in accounting. See, the report says they now recognize car park income on a gross basis. What that means is, before, they were probably reporting the profit, the money left over after the parking operator took their cut. Now they're reporting the entire amount of money collected from drivers as revenue, and then just listing the operator's fees as an expense somewhere else. So yeah, the top-line revenue number gets a big boost, but so do the expenses. The actual profit from parking might not have changed much at all. The key thing here is that a big slice of that headline growth is just an accounting switcheroo, not a pure boom in business. And this brings us to the real reason we're even talking about that credit card analogy. To understand why a company with growing revenue can't pay its investors, you have to look at the enormous financial challenge it's been facing, its debt. You see, for years, LMIRT had this really dangerous mismatch going on. Its malls are all in Indonesia, so all its money comes in as Indonesian rupiah. But a huge chunk of its loans were in US dollars. That creates this massive currency risk. I mean, think about it. If the rupiah gets weaker against the dollar, which happens all the time for reasons that have nothing to do with their malls, their debt suddenly becomes way more expensive to pay back. So they started this massive strategic push to refinance their debt into the local currency, the rupiah. It's about aligning their debt with their income, which is just a much, much safer way to run the business.
And this was no small job. Just look at this timeline to get a sense of the scale here. It all started back in 2023 with a huge refinancing push. By 2024, they had to somehow pay off $250 million in notes that were due. They pulled it off by getting several massive new loans in Indonesian rupiah, and then just last month, they managed to aggressively pay down another US $200 million in debt. down to just a tiny fraction of what it was. These are huge, decisive moves to get their finances in order. But moves like this, they're incredibly expensive and they just soak up enormous amounts of cash.
Which leads us directly to the consequence of all that hard work. All of those big debt maneuvers required cash, a ton of it. And that forced management to make some really tough calls, which led to what they're calling their cash conservation strategy.
And here we go, another fascinating puzzle. On the one hand, the business itself, the actual running of the malls, has generated a positive cash flow of over $63 million so far this year. That's healthy. The malls are making money. But on the other hand, the actual cash they have free in the bank has shrunk from $20 million down to just $11.4 million. So where'd all the money go? Simple. It went straight out the back door to make those massive loan repayments. The business is like a cash machine, but the debt is like a fire hose springing all that cash right back out again.
So to survive this cash crunch, management put a clear 3-step plan into action. First, they stopped paying distributions on something called perpetual securities. Now, doing that triggered a rule that forced them to take the second step, stopping all payments to regular unit holders. That's why the payout is 0. And finally, after all that, they had to turn around and go to those very same unit holders, the people they just stopped paying, and ask them for more money through a $63 million rights issue. They're doing everything they can to hoard cash, service their debt, and keep the lights on, even if it's really painful for investors right now.
So they've restructured the debt, they're conserving every dollar they can. What does the future actually hold? Let's look at the environment they're in and the big risks and opportunities that are still ahead. Now, this is a very, very important piece of information. In the last annual report, the company's own auditors put in a note about a material uncertainty related to going concern. Now, that phrase sounds pretty serious, and trust me, it is. It's an official red flag from the auditors that says, hey, there are some major financial hurdles here that need to be cleared. So what does that actually mean? Let's just quickly define it. Going concern is this basic idea in accounting that you assume a company is going to stay in business and be able to pay its bills. When an auditor raises uncertainty about it, they're not saying the company is going bankrupt. What they are saying is that there are serious conditions, in this case, the huge debt and the tight cash situation, that cast substantial doubt on that assumption. It's their formal way of saying pay very close attention because this company's future depends on a few key things going right. And this really sums up the whole balancing act. The huge headwind is that their short-term debts are $72.5 million more than their short-term assets. That's a tough spot to be in, but they have a really powerful tailwind pushing them forward. They operate in Indonesia, an economy that's growing at a very strong 5.1% with help from government stimulus. A growing economy means more people with more money to spend, which is the absolute best environment for a shopping mall company. So the path forward is crystal clear. Their survival really hinges on getting that rights issue done to bring in fresh cash and then continuing to manage their finances very, very carefully. And that leaves us with the ultimate question. What you have here is a company with good assets in a booming market, but it's weighed down by this massive anchor of debt. Management has made the tough, and you could argue necessary, choice to put survival ahead of shareholder payouts for now. The plan is in motion, but will it be enough? The challenge is to convince investors to give them more money right after they stopped getting paid by selling them on the promise of a better future. Will this tough period lead to a stronger, healthier company that can finally reward those patient investors down the road? Well, that is the central question, and one that only time and their next few financial reports will be able to answer.